So this is chapter 26, part 1 of our lecture. It's a continuation of the decision-making chapters. Last chapter we talked about making operational decisions using differential analysis, where we can evaluate two different alternatives. In this chapter, we're going to expand upon that and really look at what's called capital investment analysis, where we're using some finance concepts to evaluate alternative investment opportunities. But we can look at more than just two. In fact, by virtue of using these techniques, we can actually prioritize capital expenditures. And what we're talking about here is investing in equipment, or investing in maybe a factory, investing in a fleet of delivery vehicles, things like that, where we have some financial benefit that we're measuring against the upfront investment to realize that financial benefit. So we're able to evaluate that on a financial basis using some finance concepts. Then we'll get into that in a minute. But this is important because obviously we have limited amounts of money to invest. So pretty much every company doesn't have unlimited amounts of money. And so some of the techniques in this chapter will allow us to not only determine which investments are good investments to make or that we should pursue, but also how to prioritize them in terms of being able to actually rank them from best to barely acceptable. And so that way we can, depending upon the amount of money we have available to invest, we can then go forward with the projects that we can afford and know that those are the best projects. So in this chapter, we've got 4 methods that are going to be used to evaluate whether we undertake these capital projects. And by the way, these are used in real life, some more often than others, but pretty much all of them are used at one time or another. Of the 4 methods, 2 involve, or do not involve, I should say, the concept of the time value of money. And so these are relatively straightforward, quick, easy calculations to be made, really more of a screening type evaluation to determine whether we should go forward with further analysis. The more precise and more accurate and more theoretically correct concepts utilize the time value of money, recognizing that $1 today is worth more than $1 a year from now. And so those are 2 other methods that we'll look at to determine whether and how to evaluate capital projects. So first we'll start with the non-time value of money concepts. The first one is the average rate of return. And again, these are meant to be relatively simple calculations using the information that's readily available. You can do a quick calculation to determine whether we want to move forward with these investments and move them on to a more rigorous analysis. So again, so the first method is called average rate of return. Average rate of return, the equation for that is simply average annual net income divided by average investment. So here what we're doing is we're basically looking at a return. So what kind of return are we generating on our investment? So if we're receiving, let's say, income of $100, we make an investment of $1,000, that would be a 10% return. And so that's kind of how we're evaluating this. And it's, I think, critical to point out that when we're talking about average annual income, we're really talking about accounting income here, okay? So we're not having to make any adjustments for depreciation. This would be after depreciation expense. So this would be the way we would normally report income, operating income or net income. And that's after we've taken into account depreciation expense. So we don't have to make any adjustments for depreciation. We can just take that income the way it is, and it's really just using accounting income. So it's all of our expenses, including depreciation expense. And then average, and it would be the average per year. And then our average investment is simply our initial cost plus the residual value for the investment, and we divide that by 2. So that gives us basically an average. So if we start off with a $1,000 asset, we depreciate that down to, let's say, 0 residual value, then our average asset value is $500 through the life of the asset, or the life of the project. So let's see how that works. I've set up an example. Let me move the screen down a little bit. So here we have the cost of our asset is $450,000. Residual value is $50,000, and the annual income we're going to derive is $50,000 per year. So our average rate of return calculation would simply be the average annual income of $50,000 divided by the average investment. And again, average investment would be the initial cost of $450,000 plus the residual of $50,000 divided by 2. So that's basically a $50,000 annual income per year divided by an average investment. The numerator would be $500,000 divided by 2. So we'd have an average investment of $250,000. And so dividing that out, we would get a 25% return on our investment. Now again, that's a pretty simple calculation. It doesn't take into account the time value of money, the fact that the $50,000 in the first year would be worth more than $50,000 in, say, the 5th or 6th year. And it's but it's a fairly quick and simple analysis. Uses accounting income, which is readily available. It's not as precise. We should be using cash flow, but this is, again, information that would be readily available, and we can do a quick analysis. 25% would have to be measured against maybe we have a minimum required return for capital projects, and usually that's developed based upon the risk of implementing these projects. Usually companies will set a minimum of probably around, let's just say, 15% to make sure that they've developed an adequate cushion for the level of risk involved in a lot of these projects, so that even in a worst case scenario, they're making a return that's in excess of the cost of the money to them. So if they have to borrow money at, let's say, 5%, and they can make 10% on their investment through these types of investments, then of course they're going to create value for their company. So that's the whole idea. So 25% would seem to be a project that we would want to take a closer look at and continue our analysis with. That seems to be a pretty good return. If that number was 6%, chances are it probably would not be worth the risk. And again, it would be dependent upon what that minimum threshold is that the company has established as a return. So the second method that we're going to look at also does not involve time value of money concepts. It's called the cash payback period method, or cash payback method. And basically what we're going to do is we're going to look to see how many years or over what period of time it's going to take for us to recoup our investment. So let's just say, for instance, we were going to save $100 a year. And to do that, we would have to spend $300. If you just do the quick math, you'd realize that that $100 a year, over 3 years, we would have saved $300, and that would be equal to our investment. So our payback period would be 3 years in that sense. So we'd be able to determine that whether that's good or bad. We'd have to kind of weigh some other measures, but we'd be thinking that, in 3 years we'd recoup our investment, and then any other savings after that, of course, would be pure profit or pure gain. So that's kind of how we're going to look at it from this point of view. And this is used again, but this is a very quick analysis. So we're going to take basically the investment and divide that by the annual cash flow. Now, cash flow in this case is a little different than what we talked about earlier. It's not net income. Cash flow is income before depreciation expense. So what we're going to have to do to arrive at cash flow is we have to add back depreciation expense. So if our net income is $100 and depreciation expense was $50, then the cash flow would have been $150, because that would have been the amount of actual cash before we subtracted depreciation expense. Now remember, depreciation expense is a non-cash expense. There's no money that actually goes out the door. So we don't want to factor that in as a cash expense, because there was no cash leaving the company. So what we want is cash revenues and cash expenses before depreciation expense. So the quick way to get that would be to take the operating or net income and just simply add back the depreciation expense. So as an example, let's say we had an investment of $40,000. Each year we'd have annual net income of $15,000, and in arriving at the $15,000 we had depreciation expense of $5,000. For instance, if this $40,000 investment was depreciated over 8 years, we'd have $5,000 each year. Well, what we're going to do is to first calculate the cash flow. And what we're going to do is take the net income, add back depreciation, and that would give us $20,000 per year. Remember, cash flow is always going to be the bigger number because it's before we subtract depreciation expense. So if you're confused, remember, cash flow is always the bigger number. It's before we subtract depreciation expense. It excludes depreciation expense because depreciation expense is a non-cash item. So if we look at the cash payback equation, we have the amount of the investment, $40,000, divided by the annual cash flows, which is $20,000, and that gives us a 2-year payback. Now, in terms of evaluating that, again, it depends on what sort of thresholds have been put in place, or minimums, maybe by the company. 2 years would, generally speaking, be a pretty good payback, all else being equal. Typically, 3 or 4 years is a pretty good payback. 5, 6 or more years is not such a good payback, and those projects would be, relatively more risky. In the textbook, there's more of a description of some of the positives and negatives about using these different methods. I think sometimes, cash payback is something that we probably use in our personal lives without even realizing it. Let's say in this case, you were going to refinance your house. Just taking this example, for instance, let's say that you're going to spend $40,000 in fees, but you're going to save $20,000 a year in interest payments. In this case, you would break even after 2 years. So the decision point would be, am I going to be staying in my house more than 2 years? If I think I'm going to move in a year, then you would not do that. If I'm going to be in my house for 10 years, then you would do that. You'd be much better off. So that's an example of how you could use this in your real life.